You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 1st of January 2025, and we are recording our fantasy portfolio episode this week. I'm joined today, obviously, by my co-host, John McEwen, as usual. So we're just going to be catching up on the fantasy portfolio. I have released all the previous episodes prior to this podcast for anyone who wants to catch up or hasn't listened before. But basically, on the first, I think the end of the first calendar year of us creating the podcast, way back when in was it 2021, I think we did a 1 million.
2020.
Was it 2020?
It
Oh
was,
my.
yeah. It was just, I think it was sort of autumn, winter 2020.
Oh, right. So his performance is, oh, it's just 5 years now. Oh wow.
Yeah.
Right, well, okay. Well, anyway, so when we first started the podcast, we did a £1 million fantasy portfolio, which we discussed our reasons for what we were investing in. We've caught up with it once a year, made any tweaks, seen how it was doing, and we're just doing that episode. So I'll just run through. So probably firstly, it makes sense to start with our benchmark. So we used the iShares MSCI All World Index. So for the last 12 months, the index is up 17%, and it's up 39.43% since we started the portfolio. In terms of our own performance, we will go through stock by stock, but just to give the overall figure, we're up 14.75%, so we're down 2.25% compared to the index. And overall, for the whole period, we're up 31.13%, which is down 8.3% compared to the index. In terms of our own performance, I think it's quite a conservative portfolio especially for anyone who's listened before. So we kind of did 20% commodities, or we aimed for about 20% commodities. It was then originally about 40% index funds and then another 40% individual stocks. So because of that, it was going to be a bit harder to outperform potentially than if we'd just picked individual stocks alone. However, we tried to hedge a bit with the commodities for any downturns, but then also it did just give us a bit more downside protection, which has probably worked quite nicely in some years. So with that in mind, I actually think 14.75% compared to 17 for the world index, given what's in the portfolio, I actually think is pretty good, and I'm pretty happy with it. And we don't track it compared to the FTSE, but I'm pretty sure it will comfortably outperform the FTSE for both the last year and the period. John, do you have anything else before I dive in terms of the performance compared to our benchmark or underperformance?
Well, no, I don't. It certainly is a difficult benchmark to beat. I think the only other thing I would add is, apart from the individual stocks that we have, the commodities and the Bitcoin, we did take different percentages of those different indexes from around the world, rather than just having, a baseline of, the all world index according to market cap. So it's different in that sense, even in the past, in the index part of our portfolio.
Yeah, so it's probably worth going into that a bit further. But yeah, so the world index is now about 70% US, I think, 60, 70%, something like that. Ours is a lot lower. So yeah, so we were originally 8% S&P 500, and then probably about 20% of the individual stocks were US listed. So I'd say about 28% historically. So around 30% historically has been invested in the US compared to a much higher percent for the index. So essentially, any year where the US does really well, we will probably underperform unless we have done exceptionally well picking stocks, just because of how much more weighted it is. So I think with that in mind, considering this is intended to be a UK portfolio, and like I say, we've underperformed the world index, but will have smashed the FTSE. I think 14.75% is pretty decent.
Yeah, no, I'd
It's
agree. I think it would be interesting, and we haven't actually done this calculation, but would be to work out what percentage of the portfolio is actually UK listed, because I know within those individual stocks, we've got a lot of UK companies there.
we do, yeah. So I mean, we could work it out. So I've got the weight for each one actually.
Oh, that's it.
I
Very
just
easy.
need
And you've got an Excel document open in front of you.
Yeah, so I just need to. So I'm not going to include 27.5% 0.59% of the individual portfolio is in individual UK stocks, which is probably the highest allocation of anything. So I think yeah, so we're about 27% UK. However, there's also LVMH, which is listed. I don't know if it's in France.
Yeah.
And then we've got individual US stocks. We've only got like 10% in US stocks actually,
Individually.
excluding the
Yeah.
index. So actually it's cool. Yeah, so we've done quite well actually, considering how low the US listings, how few US listings we've actually got. So I'll go through the year performance and I'll also do the cumulative performance for each item. And as in previous years, anywhere I'm thinking that I'd want to put it on the list to get rid of or add, I'll just mention at the time for us to then discuss at the end once we've got the full list, if you're happy with that, John.
Yeah, sounds good.
So, top of the list, we start with our commodities. So, we included Bitcoin as a commodity way back when in 2020, and we bought 1.29 Bitcoin when we first created the portfolio, and we have never trimmed it, and we put 2.5% in. That is currently worth 95,500. It's up 113% for 2024 and it's up 282% overall. I'd like to put this on the list to discuss trimming it.
We'll discuss it. We'll discuss it.
I will go into my reasons and thoughts, but it's more of a rebalancing issue because we are now 7% Bitcoin in this portfolio because of how well it's performed, which is a nice problem to have, but
Mm,
7% seems like quite a lot. That being
mm,
said, it's driven quite a lot of our
mm.
performance this year, so we do owe it quite a lot.
Mm.
Next, we have Bloomberg Commodity. So we have a cost basis of 120,000 and it's up 5.96% for the year and 53% for the period overall. And it now has a weight of 14% in our portfolio. I would propose just leaving this as it is. We have trimmed it already in the past, and I'm quite happy with it at 14%. I wouldn't want to take it lower unless you have any desire to trim it, John.
No, absolutely not.
Okay, that was easy. So I think we've mentioned at the beginning we were aiming for around 20% commodities, including the Bitcoin. So the Bitcoin and the commodities index is currently at 21.37% combined. We'll now move on to the index fund, which is probably just worth a sweeping comment now. So for all the index funds, my proposal is to leave them as they are. Yeah,
Yeah,
perfect.
we'll
Right, in that case,
run through the performance, but yes,
perfect.
I would agree with you there.
Yeah, so for the index funds, we put 80,000 pretty much into all of them, which was about an 8% allocation each. So FTSE Developed Asia Pacific, that is down 6.5% for the year and nearly 12% since inception. That is now worth 70,000 and makes up 5.37% of the portfolio. FTSE Developed Europe, excluding UK, that is up 2.69% for the year and 27.82% since inception and is now worth 102,000 and that now makes up 7.8% of the portfolio. S&P 500 index, that is up 26.23% for the year and 81.52% since inception and that is now worth 145,000 and makes up 11% of the portfolio. MSCI Japan index, that is up 8% for the year and 19% since inception, and that is now worth 95,000 and makes up 7% of the portfolio. Emerging markets index is up 9% for the year and 6.5% overall, and that is now worth 85,000 and makes up 6.5% of the portfolio. We have only received dividends from our index funds of 2,400, and that is because all of them except Asia Pacific are accumulating funds instead of income funds, so they're just reinvested. So we're now moving on to the individual stocks. We hadn't originally tried to do it, so it was 20% UK, 20% US. However, we struggled as years went on, I think partly due to the valuations in the US, and then partly because some of the US investments performed so poorly.
Yeah.
So we ended up breaking that after a few years, so now we're just picking whatever we think is best. But that was how it was originally constructed. So going down these, we have Associated British Foods, which we added to the portfolio after 1 year. So that's only been in since 2021. And that is down 13.83% for the year and up 2.3% overall. It's worth 20,500 and makes up 1.56% of the portfolio. I would propose discussing potentially adding to this because it's a business we both like and it's not had a fantastic year, but I think it is a company that's always put up the numbers when we've covered it. So I'd like to put that on the list for discussion, John.
No, I'd certainly be in agreement with that. And I think it's worth saying that the numbers from Primark, particularly in the US and the growth there, have impressed us. And I think there's a lot of potential growth ahead of it.
Yeah. So next up, we've got Airtel Africa. That is down 11.74% for the year and is now down 5.98% overall. Airtel Africa is now worth 41,000 compared to a cost of 43, so it's already a double allocation. I do like it. I think it's a good valuation, but I think it's sitting at just over 3% of the portfolio and it is a high risk stock. So although I like it and I like the valuation, because it's already a double allocation, I wouldn't propose adding to it, but equally I'm quite happy to keep it. What about you, John?
No, agreed. I think it's a hold.
Next up, we have Boohoo. Boohoo is down only 10% for the year, and it's down 71% since we bought it, which was in 2021. We invested a total of 20,000 and it's now worth just under 6 and it doesn't pay a dividend. I'm surprised we didn't get rid of it last year, but I think that's
Mm,
probably because at that point we were both still holding on to it. I've
mm.
since sold it. I don't know what you're doing with yours, but I'd propose getting rid of this.
I haven't yet sold it, but I'm planning to. And yes, I would be in agreement with doing the same in our fancy portfolio.
I mean, it sounds like it's we're both in agreement. But anyway, I'll put it on the list and we'll just confirm that at the end. Next up is British American Tobacco. So that was only added last year. We put 20,000 into it and it is now worth 20, just under 25,000. So it's up 23.5% for the year. We've also had £2,000 of dividends from it and it makes up 1.88% of the portfolio. I should caveat that we did make clear that this was ethical reasons aside when we invested in it, although I do own it personally. I would propose just leaving it because I think the valuation is still decent and it's still yielding like 8% if you're okay with that, John.
Yeah, no, that's fine.
Next up, we have Games Workshop, which was added to the portfolio in 2021. We it looks like we gave it a 1.5 allocation almost. So we've had 32,400 go into it. It's up 35% for the year and 44% overall, and it's now worth 46,600. We've also had £1,300 of dividends from it. I'd propose leaving this as it is. I think it's a great business. It's not as cheap as it was, but I think it's still got a lot going for it. And although it's 3.5% of the portfolio, I think it's a solid business and I don't really want to get rid of it. If you're okay with that, John.
Yeah, no, absolutely. And I think, looking back, it looks like we got in at fairly reasonable levels on it, actually.
Yes, we did. So next up, we've got Gamma Communications. We added this after 2 years in 2022. We put 20,000 in. That's up 39% for the year and 41% overall, and it's now worth 28,000. It's making up 2% of the portfolio. We can put it on the list, but I'd propose getting rid of this now.
I would probably be in agreement with you there. We can put it on the list and have a bit more of a
Yeah. I mean,
discussion
it was me
later.
that I think pushed
Yes,
for it to
yeah,
go
I
on anyway because I
know.
owned it at the time and I've since
Yeah.
got rid of it. Next up, we've got Louis Vuitton, which we put 20,000 in. So again, it was about a 1% allocation, sorry, about a 2% allocation based on that original amount invested of 1 million. It's down 12% for the year and 16% overall. So we put 20,000 into it last year as a new addition to the portfolio. It is down for the year, and our 20,000 is now worth just under 17. We've got a 1 year performance of 12% for the stock, but we're down 16%, which I think is due to exchange rates
Mm.
because it's priced in euros. So that's what threw me on it. I like this business. It's not had a great year, but I'd like to put this on the list to consider adding to.
I'd be keen on that too. I think it's looking more attractive from a valuation perspective.
Right. Next up, we've got Unilever. So that's been in the portfolio since inception, and it looks like we have added to it at some point as well because it's got an allocation of about 30,000. It's up 19% for the year and 10% overall, and it's currently paying just over a 3% dividend. It's now worth 33,000. I'd propose just keeping this because I'm pretty happy with it, but I don't think I'd add to it again given the valuation. What about you, John?
No, I'd agree. It's sort of a stalwart of the portfolio, and I'd leave it alone.
Next up, we've got Supreme, which we added after 2 years. And we've made this look like a 1.5 position because it's 30,000 cost. It's up 65% for the year and 74% overall. It's now worth 52,000. I would like to discuss selling this later on or trimming it. Well, I'd like to discuss trimming this later on, mainly because there are a few longer term risks with the business. And one issue we have with it is it's a business we need to keep an eye on, but we only do this once a year.
Yeah, well,
So I
that's
don't want to be
true.
sat here in a year wishing we trimmed it slightly.
Yeah, okay, fair enough. And
I'll
I
go and
assume you're sort of alluding to regulatory issues with the
yes.
vaping market. Yeah.
Yeah, so
Okay.
I'll go into it a bit more when we go through the ones we want to trim in more detail. Next up, we've got Taylor Wimpey. So we that's been in the portfolio since inception. We have added to it as well. So it's got a cost basis of 30,000. It's down 15% for the year and 11% overall. And it's now got a value of 20, just under 27,000 compared to a 30,000 cost. We are getting a pretty nice dividend yield on it. So we're getting 2 grand of, well, just over 2 grand of dividends a year. I think we talk about it on the show quite regularly. The housing market has quite a lot of tailwinds. We're both keen on it. We do have an undersupply of housing in the UK. It's a good dividend payer. It's a good business. I'm quite happy to just keep holding this.
Yeah, no, I'm doing the same in my own portfolio. Not Taylor Wimpey, but one of the other house builders.
Right. So sticking to the housing theme, next we've got Rightmove. So that's got a cost basis of 30,000. It's been in the portfolio since inception, but then we have added to it. It's up 15% for the year and 8% overall, and it is now worth 32,000. I'm quite happy to continue holding this. It's not cheap, but it's a quality business.
Yeah, I would agree with you, and I think you saw that with the potential or the discussions that were happening in the press in terms of the potential acquisition earlier in the year. Well, actually, now last year, and actually all of the investment case that we'd made for it being made, and actually even with the premium that was being offered, it wasn't enough.
No, so yeah, quite happy to continue holding this.
Yeah.
Next up, we've got Diageo. That's also been in since inception, but we have added to it and made it a double allocation. It's down 10% for the year and 12% overall. However, it is now yielding over 3%, so we're getting a grand of dividends a year from it. Well, I'd like to actually consider adding to it again. So it's already a double allocation, but I think it's a quality business. So I think there is some merit to discussing it.
Yeah. No, not to get into bad habits, but I would agree. I think we should discuss that.
Right, perfect. Next, we're on to the US holdings. So we've got Fiverr. We added that after a year because the valuation came down considerably in that first year. Unfortunately, it then dropped about another 70%. We did top it up last year, so we added another 10,000 to our initial 20,000 investment. And since last year, it's done quite a bit better. So it's up 21% for the year and down overall 40%. It's still pretty cheap, so I think I'd consider well, I'd like to leave this be, but that's subject to a wider discussion, which I think we're going to get into about potentially adding Upwork into the portfolio, either as well or instead,
Yeah.
if you're okay with that.
I know I'm fine with that. I mean, in my own portfolio, I have both Fiverr and Upwork. So,
As do I.
yes. So yeah, we
Right.
can talk about that basket.
Okay. Next up, we've got Etsy. So it's been in the portfolio since inception. We have also added to it, although not a huge amount
Mm,
because, well, partly due to performance. So it's got a cost base of 27,000. It is down 35% for the year and it's now down 60% overall. I did consider putting this on the potential list to discuss, but I
mm,
think having added to it already and it then
mm,
having continued to perform poorly, although I think the valuation is extremely attractive, I think it's just not worth getting into the habit because you can add all
yeah.
the way to zero. So although I like the valuation, I think unless we see some kind of positive performance in the next year, I don't think we should throw good money after bad potentially. Although I do
Sounds sen-
like it.
sounds sensible. At least not in our fantasy portfolio.
Absolutely, I'll leave that to my real portfolio. Next up, we've got PayPal. So that was added to the portfolio after 2 years. It's got a £20,000 cost basis, and that is up 39% for the year and 15.5% overall. So that's now worth 23,000. I think it's still pretty reasonably priced. I think we were unfortunately a bit early getting into it
Yeah.
because it had a bad first year. Well, bad first year. However, we only get the chance to add once a year, and it was at an attractive valuation at that point. It's now at just under, well, it's at 1.76% weighting. So I think I'd just leave it as it is, actually. I feel like we've missed the boat to add to it when it was cheaper, and I'm quite happy with the weighting now. So I'd just leave that one and see how it goes.
Fine. It's one. I mean, it's one of your picks, and I'm happy with that.
That's fine. Next up, we've got Kraft Heinz. So that's been in the portfolio since inception. £20,000 cost. It's down 19.5% in the year, but it's only down 5.5% overall. It does
Yeah.
pay a 5% dividend. So we are probably up when you include the dividends we've had over the
Yeah.
years. If we've had four or five, so if we've had 4 or 5% a year, so we've not actually done terribly on it. So it's worth 19,000 compared to a £20,000 cost, but that excludes the dividends. I'd like to put this on discussion to consider selling it at this point because it has had 5 years,
Yeah, no, it's
four
a
years.
fair for having discussion about it. It has been underperforming relative to the rest of the market.
Right. Next up, we've got Walt Disney, a favorite of the show, if not the favorite. It's been in the portfolio since inception. It's been topped up.
Oh
I don't know if it's, in fact, let's see.
no.
It's been in the portfolio since inception and it was in as a double allocation and it's then
Oh
since been
no.
topped up. So we've got a cost basis of 56,000. It's the highest cost basis we've got for an individual
Yeah.
stock. It is up 22.75% for the year, and that means we're now only down 15% on
Oh
it. So
God.
it's now worth 48,000 compared to 56 cost. We are getting a 1% dividend a year almost from it, but that's not a huge amount. I would propose just leaving it. I wouldn't
Yeah.
add to it again because the cost is so high, but at least it has started to perform a bit better, hopefully.
Yeah, absolutely fine.
And next up, well, it's a final stock. It's Wix, which we only added last year. It was a half allocation because we thought it was quite a risky one. So we only put in 10,000. However, it is up 81% for the year and we're up
Hmm.
86% overall. So I'm putting the difference down to exchange rate movements. So yeah, we're up 86% on this in a year. It was only a 10,000 allocation. So it was a half, what is a half weighting for this portfolio. So it's now worth 1.42% of the portfolio. I'd just leave it. I think it's only had a year and it's still quite a small weighting. So I'd probably give it another year. What about you?
Yeah, no, I think that's absolutely fair enough.
Unfortunately, I did actually sell this myself
No.
because I owned it personally, and I sold it to buy a car. But so and most of that increase has I think happened since I sold it. Unfortunately,
Yeah, and you could have had a better car now.
I could have had a much better car. Yeah, but I'm very happy with my car, so that's life. Should have sold Boohoo for it, but anyway. So we also have cash of 17,000. That's the highest amount of dividends we've had in a year, partly because some of the stocks that pay dividends have paid higher dividends, but also quite a few of the stocks we've been adding have been quite good dividend payers in the last few years. Particular shout out to British American Tobacco, which was paying about 10, well, it was over 10%, just over 10%, I think, when we bought it. So in terms of the dividends, we've got a total of 17 grand. Honorable mentions. We're getting over 2 grand from Asia Pacific, but that's because it's an income rather than accumulating fund. We get 1,700 from Airtel Africa, which is a 4% yield. British Americans now at 8%, which is 2 grand. We're getting just under 3% from Games Workshop, which is 1,300. We get just over a grand from Unilever, just under 1,500 from Supreme, over 2 grand from Taylor Wimpey, a grand from Money Supermarket, and just under 1,100 from Diageo. We also get a grand from Kraft Heinz. So if we go on to the proposed trims, then the first one I've proposed is Boohoo. I've already sold this personally. I think you've gone off it. For me, I feel like the thesis has changed. Sort of these Chinese competitors and stuff just weren't there when we bought it. We've given it a good amount of time. The American expansion has failed miserably. And then to top it all off, what I would have considered the beacon of hope of Mike Ashley coming in and sorting it out, that vote's gone against him. And that was the only thing that I would have thought would have been a catalyst for change at this point. So I'd be quite keen to get rid of it, subject to your thoughts.
Yeah, no, I would be in agreement with that. I think one thing I should say though is that you say the Chinese competitors weren't there. I think we were less aware of it.
Yeah.
And it's not an industry that or we're not really consumers in that industry. But had we asked our girlfriends about this at the time, they probably would have said that they hadn't shopped on Boohoo for a few years and that their friends don't shop on Boohoo and they were actually, well, using some of those Chinese competitors, and therefore it probably wasn't a good investment. But we saw Boohoo, which we'd sort of followed loosely, certainly when it had been much more expensive. And it was the classic falling knife that we caught because we thought, oh, well, valuation wise. And I guess some of that demand in America and building the warehouse maybe distracted us a little bit.
Yes, I'd agree with that. So yeah, valuable lesson at least.
Yeah,
And
that's
for our
right.
fancy portfolio, it's been a £14,000 lesson. So very valuable. So yes, we've raised £5,751 from selling that, compared to a initial investment of £20,000. But at least it's gone now.
Yes.
Next up, I'd like to discuss selling Gamma Communications. This was my pick anyway. We are actually up quite nicely on it. So we're up 41% overall on it. It's been in for 3 years. I've sold it myself personally at a similar price. And I think the main issue for me is just the more I've followed the business, the more I've realized that I just don't actually understand it well enough. Although it has performed well, and it from everything I see, it seems like a quality business, but I don't have any way of assessing how well, firstly, I struggle to understand how the technology works, but then I don't really have any way of assessing how sustainable their competitive advantage is. So I just want to sell it, not because it's a bad business, but because it's done quite well and it's a business that I just don't fully understand.
No, fine. I will be in agreement for those reasons too.
Lovely. So that raises £28,228. Next one I'd like to discuss is Bitcoin. So Bitcoin's done incredibly well. So it's up over 100%. It's up 280% overall for the since we bought it at inception. We have previously trimmed the commodity index when that was roaring away. And I think with Bitcoin now at over 7% of the portfolio compared to a 2.5% initial cost, what I would propose is because we bought 1.29 instead of one, just because we wanted to put 25,000 in because that was 2.5%. So we ended up with 1.29. I would trim it down to one whole Bitcoin and then just leave that and see how it goes.
Mm,
That would be my suggestion, subject to your thoughts.
yeah, it's a tricky one. I think there's more of a bull case now for Bitcoin than when we first bought it. And to me, I'd be inclined just to keep the whole thing and just let it run. And we'll see where it goes. I think when you've got the Trump administration coming in, the talk about sort of, I suppose, regulation and giving it more legitimacy as well. I think this is all very supportive for it. So actually, with the cost that we got in at, despite the volatility, I would probably just hold the full amount.
I agree with your arguments, but then it's over 7%.
Mm,
If we were to start in a portfolio today, I don't think we'd put 7% in Bitcoin.
mm,
That's my concern. And I just don't want to be sat here in a year thinking, well, why didn't we take anything? I'm not going to force it because I do quite like Bitcoin myself, so it doesn't take much for me to be persuaded. But that's my concern with it.
okay.
It's the
If we
waiting.
okay, if we're trying to beat the index, which we have underperformed over the last 3 years by about 8%, we're going to have a higher conviction
Yeah, but
with.
then we shouldn't take higher risks to try and make up what we're lagging because you wouldn't do that with a real, or you shouldn't do that with a real portfolio. The
Mm,
performance kind of is what it is. And like we said at the beginning, I think given how well the US has performed, I actually think our performance for a UK-based portfolio is pretty good. I don't, because equally we could just sell everything because we don't pay taxes in this fancy
well,
portfolio. So we could sell everything and go all in on Tesla if we're going to take that approach.
yeah, I don't. I think that's taking it to an extreme. If it were my own portfolio, and I think if I had that much Bitcoin in it, relative to the rest, and I know it's sort of 7%, I probably would just let it run at the moment. That would be my. I
Okay.
don't. Yeah,
Well, my proposal only would have raised 21,000, so
yeah.
I'll leave that then. We'll keep
Okay.
the Bitcoin for another year, and
Okay.
hopefully we'll be sat here in a year's time and we've caught up the S&P thanks to it. Right.
Okay.
Next up, we have Supreme. So I really like Supreme. I own Supreme. However, 50% of their revenue comes from vaping. There's quite good reason, which we discussed on the show, to think that the vaping ban that's coming in 2026 could actually be a positive for them, or at the very least, not as negative as people think. However, Supreme has had a fantastic year. It's up 65%, and my concern is we only get the chance to do something about this once a year, and it's done so well, and there is that regulatory concern, and it's now worth 4% of the portfolio, that I think there's some logic to just trimming it and taking it down to a more sensible level. So my proposal would be to trim it basically down to where have I got the number from? By about half to bring us down to 15,000 shares. So we've got 29,500. So I've proposed trimming it by about half, which would raise about 25,000. And that's not really, well, it is a reflection on the business because there's concerns, but I'm continuing to hold this personally. It's just with that regulatory concern and the fact we only get a chance to do something once a year about this, I'd rather err on the side of
Yeah.
caution.
What do you think, though, about the regulatory side of it? Because there is, as you sort of alluded to, the argument that actually that's probably not going to hit Supreme. They'll change in terms of not having the disposables. But do you think that's fundamentally going to
I don't think
erode
so, and
profits?
I don't think so. But the issue is, I just it is a complete unknown, and at
Mm,
4%, it just makes me a bit uncomfortable. And again, it's a similar argument to Bitcoin, where I
mm,
wouldn't put it at 4% if we started again today. So what trimming it would do is it would take it back down to about 2%, which is I'm
mm.
quite happy with that. So I don't want to get rid of it, and I'm continuing to hold it personally. If we check this in, to be honest, if we checked in every 3 months with this, which I think there's very good reasons that we should not do, because I think only being able to do it once a year has probably improved the performance. Because I think if we'd been allowed to tamper with it, we would have actually done worse.
Yeah,
But if we did check in with it every 3 months, I'd probably want to keep the whole amount because I think you've
yeah.
got more chance in the run up to kind of assess the situation and what's happening and what the data's saying or what's going on politically. Whereas we don't
Mm,
have that, and we'll be there in a year where basically kind of the day the vaping is it 1st of Jan next year, or I don't remember exactly when it is, but basically just
mm.
before the ban is coming in is our next chance to sell it, and by then it might be too late.
Yeah. No, no, fair enough.
And I think there's also always the concern that someone could come in politically and bring in additional legislation that we've not
Yeah.
even considered.
Yeah, no, that is true.
Because
Okay.
I think we've seen it like in the last few days where Belgium's now banning disposable vapes and they're the first EU country to do it. And there is a bit of a change in the sentiment towards vaping now. So I just think selling's probably sensible.
Fine. Yeah, that's okay.
Okay, so we'll trim that, and that will raise £25,691 and take us back down pretty much to it'll still be about 2%. Next up, we have Kraft Heinz. I'd like to consider selling this, partly because it's been in 4 years and hasn't really done very much, but we've had Unilever in the same amount of time, and Unilever's now starting to come good. In this time on the show, we've been following other businesses that I think have consistently performed better than Kraft Heinz. But then also there's the issue that I don't think we really follow Kraft Heinz a huge amount. I think in the last 12 months, I'm not sure if we've actually covered it on the show. I can't
Yeah.
remember. Um,
Yeah. I think it's been a laggard for a while. There has been endless talk of turnaround over the last 5 years. Nothing's really happened. Revenue has gone down. So yeah, I'm not going to fight you on that.
that will raise £18,941. And when added to our 17,315 cash from the dividends, that gives us just under £96,000 to play with for reinvestment. So, in terms of what I'd like to consider reinvesting in, we're not going to be able to do all of them. Ones I'd like to consider, I've got 8 for the list. So, we've got Associated British Foods, Louis Vuitton, Money Supermarket, Diageo, and then in terms of so those would be top ups for existing positions, and then for new positions, I'd like to consider YouGov Fevertree, Supermarket Income REIT, and Upwork. So I don't know if we may as well just start at the top. So I've got Associated British Foods first on the list. It's difficult because we've only got 96,000 to play with, but It's only a 2% allocation on a cost basis, which now down to 1.56%. We've never added to it, and I think it's a business that I think we actually like this business more than when we first put it in
Yes. I don't
three
think when
years
we,
ago.
I think we haven't necessarily appreciated the American side and I guess some of the growth story there.
Yeah, so I'd probably just increase it by 10,000. It seems quite
Yeah.
simplistic, but yeah, I think there's a
Yeah,
lot
no,
to like.
that I agree.
Okay, that was easy. What we might find though is we run out of money if we've got lots of it.
We may have to go through and yeah, review this, but
See, Louis Vuitton, we discussed earlier, it's a business I like. It's got quality brands. It's had a poor year. And because of that poor year, it's now down to 1.28% of the portfolio. I did want to top it up, but I'm concerned we'll run out of money. So I don't know if I'd actually just leave it now. I don't
okay.
know what you think.
I like it a lot, and I probably would be inclined to top it up. But let's see what else we've got. How much money have we got now?
We've got 80, just under 86,000 with
Okay,
seven stocks to discuss.
let's move on, and we can come back if we do have the cash.
Okay, Money Supermarket. So it is a business that I think we both like. I own it personally, although I only recently became an owner again. It's shown itself, I think, to be a very resilient business since we first started. Well, since we first included it in the portfolio in 2020. It's down 30% for the year, but I think every time we've covered this business, I've always really liked it. And it's now yielding over 6% as well.
Mm.
It's worth 15,000. I'd like to consider adding another 10 and just it would probably just take it up to about a 2% position again.
And how much, sorry, were you suggesting allocating?
So we've already got
Or how much more were you suggesting? 10?
another
10?
10,000, so it would take it up to a 2% position basically.
Mm. Yeah, no, I think again, I think that's reasonable.
Okay. I could leave it if you want, if you're not that keen, and come back at the end like we said with Louis Vuitton.
We'll see. I think 10 for money is probably reasonable.
Okay. And next up, we've got Diageo to discuss. So this is the last edition that we're discussing, and then the rest would
Yeah.
be the last top
Yeah.
up, and the rest would be additions. So Diageo, it's already had a double allocation.
Yes, I know.
It's not performed terribly. Well, it has performed badly, but it's we've put in 40,000. It's now worth 35, and we're getting a grand a year of dividends. So we haven't done terribly from it, as in we've not lost a huge amount. And it's a business we both like. I think it's at quite an attractive valuation at the moment. Although we thought that last year, I think we added to it last year as well. Let me just check. Yeah, we added to it last year. That was when we made it a double allocation. I think I would throw another 10,000 at it because I
Yeah.
do really like the
Yeah.
business, and I don't. I think in 2 or 3 years, I don't think.
Yes.
I think we'll wish we'd taken the opportunity to add to it.
Yeah.
And I think because it's got so many quality brands, I don't view it the same as, for example, topping up Etsy like we discussed before. I think there's a lot more downside protection with Diageo.
Yes, no, I agree with you there, and I think it's in my own portfolio. I have been reinvesting the dividends and some other dividends into Diageo, so that's what I'm doing myself. I think I'll do it in the fantasy portfolio too.
So 10,000 would take us to a total cost of 50,000 for it, which I think is fine. So that's all the top ups discussed. So we've now got potential new additions to the portfolio. I think so. I've put four on the list to discuss. So YouGov, Fever Tree, Supermarket Income REIT, and Upwork. As it stands, assuming we don't top up Louis Vuitton, we've got 66,000 to play with. So I think realistically, it's unlikely we'll get to do all of them. Are there any of those four where straight away you'd want to rule them out, or do you want to go through them all individually?
I don't think there are any that I want to rule out there. I think YouGov, we've covered that on the show relatively recently. We both like that, and it seems to be at quite an attractive valuation at the moment. I think looking at the balance of the portfolio, we're getting rid of Kraft Heinz. You do wonder about replacing that maybe with supermarket income REIT, which is going to be providing you with very decent dividends and sort of steady returns there. I think that's sort of, I guess, a bit more of a defensive option in there. Upwork, yes, we like it a lot. It's similar to Fiverr. Perhaps it's a slightly better business than Fiverr. Whether we take a new position there, or whether you even sell your fiver and swap it for Upwork. That could be an option. And then Fever Tree. Do you want to make a bit of the case for Fever Tree, Sam?
Yeah, so it's a business we've covered, well, I think pretty much since inception of the show. I think we've always liked the business and the brand. The issue has been the valuation, and that has really, really come down in the last year or so. I think it's high risk, but the American market is now bigger than the UK, and that's still growing at about 10% a year. They've had a lot of issues on the cost side, but I'm hoping they'll be temporary because a lot of it's to do with, like, for example, the cost of glass going up in the cost of living crisis, and bottling is their biggest cost. So I think there's a lot of reasons to think, firstly, it'll turn around on the cost side, but then there's still, I think, a lot of potential for revenue to increase with the US market. And then with probably the UK and Europe just remaining quite saturated. I'll just check the valuation. Well, actually, in fairness, all four of the stocks that I'm proposing to add I do own. It's the PE is actually pretty useless. So it's at a PE of 51. But if I just do it on, we do it on the 2021 earnings, which I hope they can get back to. That would put it at normalized PE of 17, 18,
Hmm.
which I think, considering potentially the growth it's still got ahead of it, is pretty cheap. Considering it's historically had a PE, I think that the average has been around 50.
Hmm.
And it's a company that is still growing. The shares are down 75% over the last 3 years. And I do think in that time the business has got better.
Yeah. Where do you think that leaves us with YouGov and supermarket income REIT?
So supermarket income REIT, I really like it. I agree it's more defensive, but equally it's at quite a decent discount to the net asset value. It's
Mm,
paying a very nice dividend. I'll just check it. Yes, it's trading at a 24% discount to the net asset value and it's yielding almost 9%. So supermarket income REIT, I really want that in there. I've taken quite a large position on that one myself, and then I've taken smaller positions on Fevertree and YouGov. I'd be quite happy to put 20,000 in supermarket income REIT, and then maybe to reflect the higher risk. So I'll do YouGov as well. So YouGov, we've covered them both light. I do think it's riskier though than supermarket income REIT because I mean supermarket income REIT is over 100% rent collection since
yeah,
2017. So
yeah, yeah, yeah.
I do think that's lower risk. I think that's just a sentiment thing. YouGov and Fevertree, I probably would just put 10,000 into each, and then I think they're both down so heavily that if they do what I'd hope they can do, they'll probably end up in a decent size, being a decent size position. But
Yeah,
then the downside's only 10,000.
yeah.
So I think I'd initially propose 10,000 YouGov, 10,000 Fever Tree, 20,000 supermarket income rate,
Yeah, let's go with that.
and see what that adds up to. So that gives us 70,000 total. So that leaves us with 26,000 to play with. We're actually doing okay so far for the money. So the
So,
next one to discuss, well, the final one to discuss is Upwork. Upwork's had
mm,
a good year. However, we've covered it before on the show, and I think it's still quite reasonably priced. We've covered both of them. We both, Upwork and Fiverr, and we own both of them personally. And I think we've kind of concluded the more we've covered it, or probably in the last year or 8, 12, 18 months, I think we both feel like Upwork is the better business of the two. But the industry has so many tailwinds that we've taken a bit of a basket approach. However, we did not do that with this portfolio.
mm.
I'm not sure why we did that, but anyway, we've put 30,000 into Fiverr and it's now worth 18.
Mm, yeah,
I'd maybe put 15,000 into Upwork
yeah. So
just so that
just
they're at
divert. Yeah,
similar levels and just accept that Fiverr's had a bit more money into it, but I
yeah,
don't really want to sell Fiverr when we like it and it's down 40% because
yeah.
it's
No,
only a
I'd say need to.
1.37% position, so I don't think we should be trimming it really.
No, no. Okay. So should we do that? The 15.
Yeah, so 15 in Upwork. Because as well, that then even combined, they're going to be like less than 3% of the total. So it's not huge risk on a valuation basis or anything. So yeah, so that takes us to 85,000. So we've got about 11,000 left to play with. So given you're so keen on it, we would actually have money. We could put that
Yeah,
into Louis Vuitton if you wanted.
yeah. LVMH. Let's do that.
So that would give us 10,929 to go into Louis Vuitton as well. So just to confirm the proposals, we're proposing selling Boohoo in its entirety, selling Gamma in its entirety, trimming Supreme by £25,691, selling Kraft Heinz in its entirety, and then taking the cash from the dividends as well. The money would then be used to top up Associated British Foods by 10,000, top up Louis Vuitton by 10,929, top up Money Supermarket by 10,000, top up Diageo by 10,000, start a £10,000 new position in YouGov, start a £10,000 new position in Fevertree, start a £20,000 new position in Supermarket Income REIT, and start a £15,000 new position in Upwork, if you're happy with that.
Sounds good to me.
Right. And then hopefully the Bitcoin 7% position going into 2025 is enough for us to catch up the MSCI World Index.
Absolutely.
Right. I think that's everything, unless there's anything you want to add.
No, I think that is everything. Thank you very much for listening, and we'll see you again in a year's time.
Well, hopefully next week, but we'll see you for the fantasy
Hopefully next
in a
week,
year.
but the fantasy in a year's time.
Right. See you next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.